Since you're in Beijing, I figure we start off with China. What would you like to hear from President Xi Jinping today? Can he strike the right balance of delivering on his message on reforms while also delivering a blow to President Trump on trade?
Well, I'm going to stay away from suggesting what the Chinese president should say. I would say that I would guess that both sides might be well served to lower the heat on the rhetoric, because there have to be very fundamental private discussions, not only on reciprocal trade and tariffs, but also on issues like intellectual property, technology transfer, the ability of foreign companies to do business in China. But all that requires pretty blunt, direct, private conversations. And I would guess that leaders around the world will be well served to set the stage to lower the heat on the rhetoric so they can have those private discussions.
Well, you know, Rob, isn't it interesting for the Federal Reserve, though, because coming into 2018, the consensus was pretty solid around 3 interest rate increases and possibly 4, depending on how the data go. Then what did we get? Tariffs on aluminum, steel. Then we get $50 billion of tariffs on China. China fires back. Donald Trump raises the possibility of $100 billion more. It was easy at the beginning, I think, for Fed officials to say, oh, aluminum and steel, it's a small part of the economy. But it has escalated. You hear the word trade war all the time. At what point is it an issue for Fed policy?
So it's important to emphasize the only tariffs that have actually been implemented or announced are on steel and aluminum. The others are, for lack of a better term, threatened tariffs. I'd still be hopeful that when we look back on this a year or 2 years from now, there will be very little in the way of tariffs actually implemented. And so I really do think that it's too early to judge how this is going to affect the economy. But I do think the rhetoric is, if it goes on for long enough at this level, is having a somewhat of a chilling effect. If you're a business person and thinking about making a capital investment, it might give you a pause. You might be wise to wait a little bit. So the rhetoric has some effect, but I'm still hopeful when we look back a year or two from now, you'll see very little actually done in the way of tariffs that were implemented. That still would be my base case. And I think we're just going to have to, I think we're in the early innings of this, but I can tell you this, having lived in Asia myself and been a business person, I don't think these issues are going to get resolved quickly. I think it'll take at a minimum months to resolve the reciprocal trade issue, and the intellectual property and technology transfer issue could take years to resolve. This is going to be with us for some period of time.
Well, you know, so short of a trade war, we've had a lot of stock market volatility. Roberto Perli, he was formerly, you know Roberto, formerly the head of Division of Monetary Affairs at the Federal Reserve Board of Governors. He said it's hard to imagine that more bad news on trade, or on tariffs, I should say, does not slow down the Fed's rate hiking path. That's what I'm trying to get at. If you've got stock market volatility, if you've got business uncertainty, does that give the FOMC, does it give Rob Kaplan any pause on thinking, oh yeah, 3 rate hikes, maybe 4 in 2018?
So here's something I think it's very important for me to do in my job, and very important for a central banker to do. There are short-term events and short-term developments that are happening all the time. Those tend to make the news. These trade talks, for example, or trade rhetoric is an example of a short-term event. Then there's the underlying fundamentals. And I think my job is not to overreact or jump too quickly to anticipate what might happen, but let it unfold. And I still will tell you, and I'm speaking now as a central banker, but also a business person, I think we're in the early innings of these trade discussions. I think it's too early to judge how this is going to unfold. I do think, though, if you see the rhetoric continue at this elevated, heated levels, it could well do some damage, and I'm watching it very, very carefully, but I think it's too soon to make a judgment on it.
Okay. So what about your call for 3 interest rate hikes, maybe 4? We've got trade tensions on one side, too early to judge, but we do also have inflation that is still forecast to hit 2%, maybe by the middle of the year, but it hasn't really gone very far. So have you given any thought to that? I mean, how does that influence your thinking?
So you've heard me say before, my base case is for 3 rate increases this year, 2 more from where we are. And so one of the things I focus on, On the short term, the cyclical developments, I still believe 2018 will be a relatively solid year for GDP growth, 2.5% or a little more. But you've also heard me say that I think the big structural drivers of the economy, aging demographics, slowing workforce growth, sluggish productivity, mainly due to skills of our workforce and weaker education levels. And the third issue, which is increasingly I'm worried about, high levels of government debt to GDP, which I think in the out years may provide a headwind for economic growth. I think the short-term growth may look solid, and I think we'll make progress this year on unemployment, labor slack. I think you'll see some firming in inflation. But I will also say in 19 and 2020, I think you'll see growth moderating. And so I think for me, the path of rates increases is likely a little bit flatter. And I think we should be raising rates, but I think we should really be doing it gradually and patiently because the underlying drivers of the economy, I think, are still very challenging, even though the short term may look solid.
Robert, it really is a conundrum, though. I mean, explain a little bit further because, on the one hand, you're saying that we're still in the early innings here. We don't know yet how this trade dispute is going to shake out. But on the other hand, your base case is still for 3 rate hikes, 2 more this year. But, does the Fed risk, though, hiking rates into what right now is a very uncertain situation that is only at the beginning stages?
Yeah. So what are things that could slow GDP growth? One of them is trade. And so we've talked about that. But it's not the only one that could slow GDP growth. Again, aging workforce, slowing workforce growth, sluggish productivity. Those are going to have an effect also. And so my own view is we ought to be raising rates. And why? Because we're at or near full employment. We want to risk overheating or over tightening of the labor market. And I do think we're making progress and we'll move toward reaching our 2% inflation objective. But I think that's all in the context that in the out years, I think growth is going to moderate. And so the challenge for us and the trade-off that I'm working on is we want to remove accommodation, but we need to do it gradually and patiently because we still got a lot of fundamental headwinds for economic growth. We can address those. But trade, by the way, is just one of them. It's maybe not even the most significant of them. I would say we've got to find ways to grow the workforce in the United States. We've got to find ways to get more people into the workforce, improve their skills. I think those 2 issues are as or more important than these short-term trade issues. And again, I'm relatively hopeful because it's so clearly in the interest of the United States as well as China that we have trade. It's so critical to each of our respective growth stories that I'm hopeful that those issues will get resolved. But those aren't the only issues I'm worrying about.
Well, Rob, I guess to paraphrase Donald Trump, you think that both China and the U.S. will do the right thing in that famous tweet from yesterday. I want to quickly ask you, though, about technology disruption. It's a very big area of study, research, and thought at the Dallas Fed. And what you argue basically is it's keeping prices down. It's keeping wages down. Coming back to inflation, and you said it's going to deepen. So how in the heck is the Fed going to get inflation up to this 2% sustained level, maybe even higher, when you've got a big headwind? Maybe it's a positive headwind in some ways, but it's not good for inflation or wages in a lot of ways.
So we've got 2 countervailing forces. One is the short-term cyclical forces. We've got a very tight labor market. We're at or near full employment. Everywhere I look in my district, but nationwide, we've got labor shortages, certainly for skilled labor, but for basically labor across the board. That's going to create wage pressure. Historically, that wage pressure would translate into prices. This technology and technology-enabled disruption you referred to is limiting pricing power of businesses. So to the extent that they see wage pressure, it may as likely come out of margins as be translated into prices. And that's the tension. And so my guess is the way this will all shake out is we'll see some firming and inflation pressures this year, but I don't see inflation running away from us. And I think the longer term forces of automation and technology-enabled disruption are going to be muting for inflation, but they also put a great onus on policymakers in the United States to improve education levels. Math, science, reading, we rank 25th out of 35 industrialized countries. We need to improve skills training, middle skills training at our junior colleges around the country. We're doing better at it, but we've got to ramp this up dramatically. We're not keeping up with the pace of technology-enabled disruption. And the reason I talk about this everywhere I go, we can do something about this. It's not going to be quick. But we can improve our situation and improve productivity and how we respond to this. I just think we're slow and we're lagging, and it concerns me.
Okay, are you concerned about the yield curve? It's flattening again. J.P. Morgan saying in the last 24 hours, it's only a matter of time until the curve inverts. What's the message? What's it telling the Federal Reserve? Is there a concern that, well, they're going to keep raising rates, you're reducing the balance sheet, and there's going to be a bunch of bonds thrown into the market now? A little bit of a red light, maybe?
Yeah. Well, let me tell you what the yield curve tells me, and having spent my career in the markets, the flattening yield curve and the fact that the 10-year has been relatively muted in terms of its upward rise tells me that the outlook for growth, for GDP growth, is sluggish. It's very consistent with all the comments I've just made about 2019 and 2020. I, for one, am going to be watching this yield curve very carefully. I do not want to knowingly tighten into a flat or inverted yield curve. I think behaviorally and from an incentive point of view, that would not be positive for the U.S. economy. The history of inverted yield curves is not positive for the U.S. economy. So that's something I'm watching very carefully. I think the Fed's got some operating room, but I think it's something I'm going to keep an eye on very closely as we go through this year. And so I'm not going to blindly say we should be raising rates if the curve keeps flattening. It's something that will be a factor in my policy judgments as the year unfolds and into next year.
Robert, I know you also watch credit quite closely as well, given what we've seen the volatility in the stock market. You were saying how we're seeing a healthy, I guess you could say, drop in stocks given how frothy levels have been. But we do see credit spreads actually widening right now. Nowhere near what we saw back in 2008. But at what point do we need to start worrying? Because if anything, we're seeing bank lending actually pick up recently.
All right, so we've got to be mindful of the fact that while the households have deleveraged in the United States over the last 8 or 9 years, corporate debt to GDP is actually at record highs. The good news is financial sectors deleverage, but corporate debt is relatively high, and we're late in the cycle. And a little bit more concerning to me is government debt to GDP is at record high levels, and we've just leveraged up at the government level, and we're late in the cycle. So it wouldn't surprise me to see credit spreads widen somewhat. They've been very, very tight. And that probably goes along with the stock market volatility we've been seeing recently. So I think some widening in credit spreads wouldn't be surprising, but that means a tightening in credit conditions. So that's why I always mention one of these longer-term drivers I'm worried about is the level of debt in our economy and the fact the U.S. economy with this amount of debt is more interest rate sensitive than it's been. And it's something that I'm very cognizant of and watching very carefully.
Okay, Rob, keep that markets hat, that, many decades investment banker hat on, and look at LIBOR for us. Now, it's receded a bit, but it had a big move up in the past few weeks. It's kind of been out there on its own. I notice there's this shift now away from LIBOR into this new measure from the New York Fed. But when you see a spread move out like that, you kind of wonder, is it all technical, or is it perhaps that there are some worries about risk in international banking markets and more? How do you interpret that? And again, are you watching it closely?
Yeah, I'm watching it very closely, and so I'm watching the so-called LIBOR or OIS spread, but I'm also very cognizant of the fact that the 2-year Treasury, the 2-year securities, have backed up, I do think, in anticipation of what the Fed has said, and so the 2s to 10s is also flattened somewhat. I don't interpret it the same way as I might have when I saw this going on in 2008, But it also, I think, there's some technical issues, but it also what's going on with the curve and what's going on with some of these spreads we normally watch just tells me that the expectation for future growth is a little bit sluggish. So again, while 2018, there's always a tendency to say we're having a good year in 2018. We've just had a big amount of fiscal stimulus late in the cycle. So, gee, the future looks bright. And I'm actually saying, and I think these yield instruments reinforce this, the short term is going to be solid. I think the longer term, driven by these big structural trends, are going to be more sluggish. And I think the reason it's worth flagging it, we can do something about some of these. We can do things to improve labor force growth. We can give incentives for people to re-enter the workforce. We can do something on immigration reform, maybe more skills-based immigration. We can do something on education, but only if we talk about the issues. And I do think we've got to do things to moderate the path of debt growth in the United States. I think late in the cycle, it's unfortunate that we've ramped up debt to GDP. And if you look at the Congressional Budget Office report, you know, it shows that in the near future, by 2020, we're talking about $1 trillion plus annual deficits. And I think you're seeing all that in some of these fixed income measures that you just referred to.